Hello, everyone. Welcome to the InfoVest podcast. My name is Daniel, and today is December 24th, 2020. And we're just going to summarize and look over today how things have been progressing in the markets. It is December 24th, so we do have the markets kind of closing down and being a little bit more less volatile than usual, as most people are on vacation or on holidays, and we can expect also early market close today and a market close tomorrow on the 25th, as it is holiday week, and next week is also going to be the same. So we'll really have to wait until um, January 4th to really start to get people and traders back at their desk and for volatility and more movement in the markets to come. So other than that, we can touch on a couple of things. A few things we can look at are the equity indices. We see that the S&P 500 continues to be in its kind of a consolidated um, motion of trading, and we do see it at 36.88 with kind of a pickup since December 21st, where we had that kind of a dip on the fears of mutation, um, the virus mutation. But we quickly saw bids around the 3600, and quickly the S&P 500 reached back to price level 1, and we're kind of just consolidating here. So no surprise in terms of the consolidation and the choppy kind of trading that we're seeing. As I mentioned, that it is holiday season and it is the week of holidays, so a lot of people are off. We can expect the same, especially during New Year's, January 1st, where it'll be a holiday, and the same thing next week, January 31st, and actually the whole week, where you'll see just a bunch of choppiness. So S&P again, just choppy. Nasdaq on the other hand, similar scenario here. Just kind of sideways motion of trading and choppiness. For the Dow, we have somewhat of a similar case here. And the only difference in terms of the all equity indices, we see Russell, the Russell 2000, finally hitting 2000. So that was a big milestone, a big achievement, and first time in history where yesterday, December 31st, we did reach to that 2000 level, and we did break that 2000 level, and overnight we see that the Russell 2000 continues its slow and gradual steady above 2000. It's sitting around 2010. So big news on the Russell. We mentioned this before also in the previous podcast about the Russell hitting 2000. We were marking it, we had our eyes on it. We'd had also call options, TNA call options, also the IWM call options, as we were eyeing this 2000 psychological mark. So we finally reached there. It was great. We here at Infovest, we are, as a disclaimer, we have sold our positions in TNA and IWM, both from a long-term position since the market dip on the Corona fear back in March, and also a short-term play this week on the IWM, which we were expecting for it to hit, especially due to the stimulus talks and the stimulus bill that was basically approved. I use the word basically because we did have kind of developments where Trump came out and said that $600 relief check wasn't enough, and they have to change, and they have to go back, and lawmakers have to go back, and he was proposing more of a $2,000 relief check. Now there's news going on that House GOP are poised to block Pelosi's bid for the $2,000 relief checks. So, I mean, I don't know what to make out of this other than this is just all politics. You did have Trump that did come out and say that, we do want to see a bigger stimulus check for the individual people. Democrats said, fine, let's do it. And now you're having reports that GOP House members, um, especially on the Republican sides, they're expected to block this $2,000 bill, and they want to kind of add new things into the bill to whatever that Democrats were disagreeing on before. They want to include that back in. So, I mean, uh, lost for words is what I have to say. They did pass, from just talking, like from the sense of coming to an agreement a week ago. They did say that it's done, they've signed it, and they're going to push it off to the president, but the president didn't want to go ahead with it, so he vetoed it, and now we're seeing this back and forth. How the markets took it, not much of it was a little bit of a dip, but it was very quickly picked back up. And like I said, it's just right now all politics. It will get passed, it will get done. The question is when, how long do they prolong it? We'll have to see. But other than that, it's nothing too negative or dangerous from the front that this will affect markets drastically. We don't think that anything major or big will come out of this. Just politics talk, political talk, and if worst case scenario for this bill, if nothing gets signed by this month, we have a week left, and nothing in January, then would have to probably wait till Biden is in power for a push through to go through for this bill. Other than that, I, from my own opinion, believe it's just pure politics. So, other than that, we have also the euro at one spot 22. We have the Canadian dollar around spot 77. Did see also oil coming off right now in the overnight session, and we did see oil rally since December 23rd, and then kind of stagnate from there. We did see oil prices rise, especially boosted by draws in U.S. inventories yesterday of crude, gasoline, and distillates. And that lifted investors' hopes for some return in fuel demand. We had Brent crude futures gain about 2% to 51.12 a barrel, and the U.S. West Texas Intermediate crude futures rose 2.19% to 48.05 a barrel. U.S. crude inventories fell about 562,000 barrels in the week to December 18 to 499.5 million barrels. The Energy Information Administration said gasoline stocks fell by a surprise of 1.1 million barrels in the week to 237.8 barrels. The EIA said while distillate stockpiles fell by 2.3 million barrels in the week to 148.9 million barrels, more than expected. So overall, what this report reflects is that we're starting to see continued improvement in demand, according to Phil Flynn, a analyst at Price Futures Group in Chicago. And he also mentioned it reflects that we're seeing a market that's getting more in balance. We also did see gold prices jump bolstered by the weak dollar, while investors kept hopes pinned on a U.S. stimulus package. And after U.S. President, as I mentioned, threatened to not sign the relief bill, and the dollar continues to remain weak. Dollar heads for a 6% decline in 2020. We see yields kind of come off a bit, and bond prices rise a bit, especially in the overnight session. Something about bonds that I do want to mention. It's kind of a play that we have here at Infravest. Um, a bond play on more on um, the long end curve of, of the bond market. So this is more of a 30-year treasury bond play. And the idea of this is, as mentioned before in the previous podcast, we did have the central bank, the Federal Reserve, come out just last week, and we were expecting this very um, dovish tone of either more QE or, if not more QE, kind of this wham or this suppression of the long end yields, or this bond buying duration moving from the short end to the long end. That was the expectation last week, and that didn't happen. And on top of that, when you look at the growth projections in the dot plot, and in its statements that were released by the Fed, we did see that the Fed did revise its growth outlook projections to more of a bullish scenario. So we did see GDP growth, we did see unemployment, we did see inflation numbers revised more on the upside than the downside, which you could say in theory that signals that the Fed sees the economy doing well next year, and it could pick up very soon, which also could signal that there is no need to provide any more additional stimulus. There's no need for more QE. There's no need to cut rates. And possibly, there's no need to of this wham concept and suppressing the long end yields or doing yield curve control. There's no needs for it. So if that's the rhetoric, if that's what the Fed is trying to signal to the markets, then that would mean that if the long end yields are not going to be suppressed, then the 30-year should see kind of a rise in yields and should see the prices nosedive. The yields are at close to all-time lows in the 30-year, and prices are at all-time highs in the 30-year. We are coming off a bit as we look into this market right now. So we're off from that all-time highs, but the projections on this trade would have to be if whether or not we will get that yield curve control, if whether or not the Fed will change its statement, its rhetoric, its talk. It could be that the Fed didn't want to mention anything until they hear something from the White House, something about more on the fiscal end, more of fiscal spending, more of fiscal support. And that's what Jerome Powell was mentioning. That was his take, that this Fed is going to be there, and if things get worse in terms of the virus, in terms of COVID, they're there to continue to support the market. and their objective is to get unemployment rate down and inflation to rise to that 2% target, especially that AIT, average inflation target. So they haven't stopped QE. They're going to continue the bond purchasing program, but they haven't done what the market was expecting, was a little bit more dovishness, and the market hasn't received that yet. It's just received the expected, and you start to question it because now you can get pricing from traders anticipating that, by maybe not by 2023, we will start to see rates to increase. It could be earlier from that, and you can get traders starting to anticipate this, and you can see more of a bid in the yields, an increase in the yields, and the prices, more on the long end decreasing, and it will be on this basis of um, traders kind of front running and anticipating that the Fed is reaching and progressing to more of a soft landing. Progressing, and what that means for any new traders, a soft landing basically means they have to figure out in the most smartest and calmest way possible to start giving hints and clues to the market that their QE program will eventually slow down, and they'll put their foot off the gas pedal and move away and start sounding a little bit more hawkish without causing a tantrum, without causing a big dip in the markets. They will have to try to engineer a soft landing. And how they do that, we'll have to see what they do and what they say. But according to the last meeting with Fed, what we've seen that the projections have been revised to more of a positive note, and there was no mention of suppressing the long end yields. So what we've decided at Infovest is there are few ETFs that follow the long end curve of the 30-year bond, of the long end bonds, and those ETFs are TBT, and the other ETF is TLTs. So through options, we bought a put on the TBTs, and TBTs is kind of a short against against the 30-year. So sorry, I want to correct myself. We didn't buy puts. The ETF is basically a short on the long end of the bonds, and we bought call options on TBT, and our price target. So the call option, the strike price that we got was around, I believe, $16, and expiring in March. And our target is to hit $20, and our expectation is this theory where the TBTs, so that is Tiger, Bob, Tiger, TBT, we're expecting the TBT to hit close to or around $20 on the expectation that the Fed is going to continue to remain bullish on the economy, and the Fed is expected to not change the WAM and not change the rhetoric on the yield curve control, where there's no yield curve control, and the rhetoric continues that our theory believes that since they're not suppressing the long end yields, we could see the yields in the long end, especially the 30-year, to break, and the prices to fall. and that will push the TBT higher towards this $20. We have the same view on TLTs. We didn't buy TLTs, but our same view on TLT is that we could see TLTs reaching down to a level of 140. So that's our take on the long end 30-year bond, the TBT, TLT. And what's amazing about this is you can um, run this strategy through options with limited risk. And we are doing this right now through the TBT. And our expectation is this could happen by March. The reason we put that in there is because we believe that just in case the Fed comes out and changes things in its next meeting, um, we will at least have closed our position by then. We don't want to hold this position more long term because it's very possible that in the next meeting that the Fed could come and say that they're going to do yield curve control, or they're going to suppress the long end yields. So that is why this is a very short-term trade, and if it is going to work out, it should work out before March. If not, then the trade is a loss, it's a losing trade, and we will manage the trade based on risk management. And remember, when you get into a trade, you're no more a trader, you're no more in the business of trying to be right. You now become a risk manager. So as a risk manager, we will manage this trade and manage our risk accordingly. If we see that our target is there's any kind of developments in the change of the Fed talk, anything where any of the Fed members or any if Jerome Powell, if he comes out and mentions anything about suppressing the long end yields, then we will get out of this position. So any new development that comes out, we will get out. But right now, our theory is that since the Fed did not mention about suppressing long end yields and did not mention about yield curve control, and the Fed revised its growth projections to more of on a positive note, we want to be long the TBT through call options, and we want to be essentially short the long end bonds, the 30-year bond, because we believe yield prices will be higher on the long end, the 30-year, and the prices to be lower. You can do the same thing on TLTs, where TLT prices you could short it via put options, and expect that we could see more of a dip on TLTs as the 30-year ZB dips. Now, as I pull up my chart here on the 30-year yield, um, we could see that the lows were on 30-year was around 0.837%, so less than a percent. And that was back in March of this year, and we're seeing a rise from then. We do see that the yields right now moved all the way up to 1.684%. So a couple of levels, if you want to look at levels on the 30-year yield. Looking at a first level at 1.891%. This is on the 30-year, and that level is quite close. If we break that level, we could continue to see the 30-year yields rise and the prices fall. And those the next level then would be around the 2.4%. And then now we could range bound between 1.89 to 2.4% in the yields. But if we continue to see more of a hawkish tone, we could continue to see this yield increase, and who knows, we could rise above 2.4, break that level, and could go all the way up to 2.8, almost close to that 3% on the 30 year. So we'll have to see. Generally, yields over time have been falling. When you look back in history, like 1988 until now, yields overall have been falling. Um, Calling this, the next yield or bull run or the next uh, kind of sell off in bonds, and breaking that trend would be very unlikely. It's a very difficult trade, but just for the time being, a very short-term trade, that these are the yields and these are the levels that I'm monitoring on the 30 year. And as we continue to break those levels, we could see yields rise. We could see the 30 year kind of depreciate or fall lower. Now, when I look at levels on the TLT ETF, so right now around 156, the level to monitor is actually around the 156 mark. I would say around, sorry, not 156, around 155, I would say. And so we want to kind of monitor that level, and if we continue to break that, the next level we want to see is 152.97, so more of 153. And then if we break that, we want to monitor and see the next level around 143. Then it would be 140, the psychological level, and then we could see 139, another level, and then coming down to 134, and then 130, that psychological level again. So a couple of levels on the TLT as well. For the TBTs, I'm looking at a couple of levels for it to break as well. So I'm watching it to see if we break the 17 dollar level, more around, let's say, 1730s, and then we could continue to see another resistance around the $18 mark, and then if we continue to break that, we want to see it reach to around $19 and then $20 resistance level. So these are the key levels on the TBT to watch out for. So this is kind of the long and 30-year bond trade. I know I spent kind of a lot talking about this, but I did want to mention it. So we talk about such interesting trades, big macro trades, macro trade plays, and anything even less also complicated on our smart money report that we have out on inforvesting.com. So check that out if you're interested. And now, in terms of Brexit, last thing I just want to leave off before heading out. For the Brexit front, there are talks and rumors out there that we are still waiting to hear a Brexit trade agreement. They're still kind of stuck on the fishery part of the deal. And the expectation, there is optimism in the pound. We do see the pound did reach to a level of 1.36 handle, and we'll have to see if they can get a deal today before Christmas. So that's what the rhetoric is, and if we do get a deal today, we could see a really nice relief rally breaking that 1.36, could reach to a level of 1.4. So that's something to continue to monitor. If not, if they extend it, they could push it. Remember, they put up a deadline for December 31st, and that's the deadline they put out, that they would have a Brexit deal. So we'll have to continue to monitor and see how things are. Other than that, quiet day, like I mentioned, it's December 24th, and it will be choppy trading day and not much movement, and people are heading for holidays and whatnot. So, wishing you happy holidays, wishing you happy new year, and may the new coming year bring you much more success, happiness, great wealth, fortune, love, and everything that you desire for in the long end and in the future. So, thanks for listening. And in terms of podcast schedule, I may be planning the next podcast once the holiday season is over with. So maybe it could be in January 4th. If I do see anything important to talk about, I could come back on and talk about it. So I'm also a little bit partially on holidays as well. Um, and so just to let you know and inform you that that's kind of my schedule going forward, and then hope to pick things back up on January 4th. So other than that, hope you have a great day. Hope you have a great holiday week, and hope you have a great New Year's. Stay safe and talk to you soon. Bye.